Can you see the silver versus gold
Yeah.
weekly close?
Okay. Now
Okay.
this goes back 5 years, and these are weekly closes of silver divided into the price of an ounce of gold expressed as a percent. So back in 2020, silver was like 0.9% of the price of gold, and it shot up to 1.5+% the price of gold. That's a big move.
Yeah.
That's like buying a stock at $83 and having it go to 155 in a matter of about 6, 7 months. Okay. So the spread shot up then. Okay. But since that peak in late 2020, early 2021, where silver outperformed gold, over the subsequent years, even though both metals rose in price, silver has lagged gold's performance. And that's why this spread chart has gone down in layers.
Yeah.
And back in April, it was back under 1% again. Well, 1%, if you go back 50 years on the spread, you'll see that is a very low level. And normally, in fact, 20 of the past 50 years, silver's at least been 2% of the price of gold. That's a normal almost. Well, you can see what's happened since April. Silver's been gaining, the spread has been gaining, the top chart there, versus gold, but it's not up to the green line. And the green line is what we're watching. That level, if you take it out, and that's 1.31%. And by the way, we've done this study using monthlies and long-term momentum, but below you'll see a momentum chart of the spread, which is measuring the spread units versus a 40-week average of the spread. And unlike the spread chart, which is still moving up toward the structure, the momentum chart has already hit it.
Yeah.
And it's headed back. Right now, we're higher than that last read of that uptick you see. So a few weeks ago, we hit the breakout point, stopped at it, pulled back, and we're headed toward it again. If momentum upticks much more this week than we already have, and you get up to about 1.25%, again, divide December silver into December gold, expressed as a percent, that momentum breaks out. And you can bet then that shortly thereafter, that spread is going to break out. Okay. So what? This is exactly what happened to gold-silver spread in late 1979, prior to the 6-month explosion. And it happened in September, October of 2010, when silver was in the $20 range, upper 20s, and it went to 50 by April 2011. What told you that it was going to accelerate was not that it was already in an uptrend, because it already was. No big deal. The spread said, I'm going to blow my cork. And during that final 6 months, what happened? Silver and gold both exploded, but silver beat the pants off of gold because the spread broke out. We're watching the top, that green line. If you break that out over 1.31%, we expect a massive rapid surge up to at least the norm of 2%. Well, even right now, if gold just sat here at $4,000, it's 4,200 actually, do 2% of that's $80 silver. Okay, but gold isn't going to sit still. And again, what if gold, as we showed on the very first chart, does another equal ratio scale bull trend move that it did in 75 to 80 and 2001 to 2011, an 8-fold move? That means gold's at 8,000 plus. Could do it fairly quickly too. If silver were 2% of that's $160 silver. And again, 2% is normal. In fact, in bull market years, 79 to 80, or in 2010 to 11, the silver gold ratio, as we measure it, percent versus percent, it was at 3.5%. And in 79 to 80 was 6%. So we could get a major explosion, not only in this spread, but it would indicate to us that the price action of silver is now going to go more vertical than you can imagine.
Okay, let me, I'm going to bring up a little bit of a longer one here. And so this is basically what you're talking about. So this is silver divided by gold. And so back here in 78, we can see that the ratio was 0.025, which basically means that, 2.5%.
It was 2.5%. Yeah.
Yeah.
And it shot up there to 8% at one time. This must be weekly or something. But
this is monthly actually.
Yeah.
So we got up to like 6-7%.
Yeah, that was a bull year for the metals. Yeah,
This is kind of what you're expecting, something like this, a re-rating of the ratio, which would, the only way to really explain that.
Well, I mean, even just to go back to the high in 2011, which was about 3.5 there.
Okay, right here.
That's enormous.
That is
even
enormous.
If gold just sat still and silver went to 3.5%, it would go off the page. We're arguing now. There's another set of charts that sort of smack you in the face and make the point. It's the base metal charts I sent you. Well, you could stay on this chart for a minute.
Okay.
But draw a line at 2%. Drop your line down to 2. Look how many times it's been at 2%. It's hardly abnormal.
Oh, yeah.
Yeah, it's no big deal. So
That's
if we
kind of
come
the
up, yeah,
average.
and you could already see the spread since 2000. There's like a downtrend too on that spread at the last couple of years, and
Yeah.
you're starting to approach that. So you could easily go to 2% just as, hey, big deal.
Yeah.
Well, that's off the page, even at current prices, in terms
Yeah.
of where is silver price versus gold. And if we're in a bull trend, so if we match the bull trends, we could go to 3 plus.
Yeah.
And you did it quickly. You didn't do it in an arm wrestling manner. You did it in a thunderbolt.
Yeah. Yeah. These are parabolic, violent moves that happen in 6 months and they're over.
Not only in the spread, but in the price of silver as well. So, yeah, and this is not unusual, by the way. Silver has made a grand mistake. It's what we're arguing. Markets make errors. Anybody who's been in markets long enough knows that, hey, that dot-com top, that was an error. It went too far, too long, and therefore it broke. NASDAQ dropped 82% in the next 2 years. 82% after that bubble broke. Because it was why? Nothing wrong with the truth internet. It changed our lives. But they overpriced it too quick and it burst. Okay. Now, ultimately, it proved itself, but it went down 82%. Okay. The same thing happens at lows sometimes. Sometimes a market will go low, abnormally low, irrationally low, and stay there. And everybody says, see, what a dog. I'm not interested in that market. Just leave it alone. Don't step on it, and when it wakes up in a way that is like a sudden jolt. Like, what am I doing down here? Flip to those charts, if you would, of the copper and lead, I think what it was.
Okay.
They make the point. So it's a reality that people
Here's
need to
copper.
realize.
And this is going back to the early 90s until present.
Yeah, you can, in fact, take that lower range you see in the 90s up to 2000. It goes back into the 80s as well. This is a Federal Reserve chart of the price of copper, by the way.
Okay.
From St. Louis Fed. I guess monthly closes or something. But anyway, you lived in a range, okay, for decades. In fact, it goes back to the 1980s. But look what happened when you came out of the range.
Yeah.
You tripled. You went from 3 to 8 to almost 9,000. You've almost tripled in price. But the first doubling was a matter of a handful of months.
Yeah.
And this, by the way, was not correlated to gold and silver at that time. They had their massive move later on in that trend. Okay, so the copper did it on its own. And then look what happened after that. Yeah, you had a big drop, but look, you live in a new range now.
Yeah. Yeah. This is
now
the new
suddenly
home.
It's a range that if you take the middle of that, about 7,500, that's still double and a half what it lived in between the 1980s and 2004. A new reality is what I'm saying. And it did it quickly.
Yeah.
And right now, by the way, copper's trying to break out of that thing again. And by the way, copper right now is trading well above its 2011 price high. It's not real clear on this chart, but when you look at a monthly futures, you can see it's above it.
If we look at that ratio over the last 5 years, we can see a fascinating story unfold. Back in 2020, silver was barely 0.9% of the price of gold. That's historically cheap, practically sleeping in the basement while gold was strutting around the penthouse. Then, within 6 or 7 months, the spread shot up to around 1.5%. That may not sound like much, but in market terms that's like buying a stock at $83 and watching it run to $155 in half a year. That's a 90% move in relative value. Silver outperformed gold dramatically during that brief window. But since that spike, something interesting happened. From 2021 onward, even though both metals rose in nominal price, silver lagged. The spread fell in layers, like a slow-motion retreat. By April of this year, it was back under 1%. 1% of gold's price. For context, if you go back over the last half-century, that's an unusually depressed reading. In fact, for 20 of the past 50 years, silver's been at least 2% of gold's price. 2% is the norm, the equilibrium. Anything below 1% is like holding a beach ball underwater. It doesn't stay there long. Now here's where it gets exciting. Since April, the spread has been quietly rising again. Silver's begun to outperform gold, but it hasn't yet broken the green line I've been watching, that key breakout level at 1.31%. On the momentum charts, which compare the spread to its 40-week moving average, we've already kissed that ceiling once, pulled back, and are heading right back up toward it. If momentum ticks just a bit higher, say 1.225%, that would trigger a confirmed breakout. And when momentum breaks, price follows. This is exactly what happened in late 1979. right before silver exploded from under $20 to $50 in 6 months. It also happened in September and October 2010, when silver was in the high 20s and raced to $50 by April 2011. In both cases, the gold-silver spread flashed the signal first. I'm about to blow my cork. Gold went up? Yes, but silver beat the pants off it. If we take out 1.31% on this ratio today, we expect silver to surge to at least the historical norm of 2% of gold's price. That may not sound dramatic, but at $4,200 gold, 2% equals $84 silver. And remember, gold is unlikely to stand still while this is happening. Let's play that out. Suppose gold does what it's done in every major bull run since 1975, an 8-fold advance. That takes it from its 2015 lows near $1,000 to $8,000 plus. If silver just normalizes to 2% of that, you're talking $160 silver. At 3%, $240. And in 1979 to 80, silver's ratio peaked near 6%. That's the kind of violent catch-up we're talking about. People forget that silver, for all its industrial uses, is still first and foremost a monetary metal. It's been money for 3,000 years. Yet in modern finance, it's treated like a volatile cousin of gold. Too small, too emotional. That's a mistake. Markets make errors. Sometimes they overshoot on the upside. Think of the dot-com mania, when the Nasdaq ballooned 80% above reality before collapsing 82%. But markets also make errors on the downside. They can leave assets irrationally cheap, despised, ignored, until suddenly the crowd realizes the mistake and price has to leap to catch up. Silver is that kind of market right now. It's been left for dead. But when it wakes up, it will jolt upward like a spring that's been coiled too tightly for too long. To understand how fast that can happen, look at other commodities that went through long dormancy before breaking free. Copper is a great example. For decades, all through the 1980s and 1990s, copper traded in a dull sideways range around $2,000 to $3,000 per ton. Then, almost overnight, it rocketed to $9,000. The first doubling happened in just a few months, and when the dust settled, even after a correction, copper lived in a completely new reality. A range centered around $7,500 instead of $3,000. That's a permanent re-rating of value. Silver's story could be even more dramatic because it carries not only industrial demand, but also monetary fear. We're heading into a period when fiat currencies will be questioned, perhaps not just by investors, but by governments themselves. Some countries are already discussing gold-backed settlement systems. Japan, the EU, and the US may end up being the last to admit it, but even they will be forced to face the music. When that crisis of confidence comes, and it always comes, gold and silver will be repriced sharply higher. And once the new reality sets in, you don't go back. I'm not talking about a quick speculative spike that collapses afterward. I'm talking about a structural repricing of money itself. When copper or lead broke their old ceilings, they didn't retreat back into the 1980s range. They lived in new plateaus. Likewise, when silver finally breaks free, the days of $20 or $30 silver will look as distant as the days of $300 gold. The new normal could be $100 to $250 silver, depending on how aggressive the fiat currency debasement becomes. Think about what's happened to everything else we buy: bread, beef, housing, energy. Every one of those has tripled or quadrupled in price over the last generation, reflecting the steady decay of purchasing power. Yet silver, which hit $50 in 1980 and again in 2011, still trades around those same nominal levels. Adjusted for inflation, it should already be near $200. The disconnect is enormous. The market's error is obvious, and when the correction comes, it will be swift and probably shocking.